Hello, everyone. My name is Alexandra Carade, and I'm a member of the Virginia Early Childhood Foundation Business Coaching Team. In this video, we will be discussing the Families First Coronavirus Response Leave Act and the Employee Retention Tax Credit. These are intimidating names, but we'll walk through in this video to discuss how these work, eligibility to apply, and how to claim these. The FFCRA stands for the Families First Coronavirus Relief Act. The FFCRA is intended to help small businesses and nonprofits handle the costs associated with leaves of absence, which employees needed to take for reasons related to COVID illness. We'll go into these specific reasons shortly. The FFCRA came about because the government saw a lot of small businesses and small nonprofits struggle to afford to offer their employees the time off that they needed during the COVID pandemic. So we can think of the FFCRA as if the government is helping to support your business for the times that you paid your employees and they were unable to work. The Employee Retention Tax Credit is, simply put, a way for you to help keep your staff on payroll. This program is very similar to the Paycheck Protection Program, the PPP, but even easier. Think of this one as if the government is refunding your employer Social Security taxes. So it's like a reimbursement of these Social Security taxes. If you employ W-2 employees, you are eligible to use the ERTC. We'll get into that soon enough, but first let's start with the FFCRA. The FFCRA helps to cover money that the business lost when employees were not able to work due to COVID. Perhaps you or one of your W-2 employees contracted COVID, or you had to quarantine. The FFCRA leave applies to individuals, or it could apply to your entire facility. For instance, if your facility had to close for 2 weeks due to a quarantine. The FFCRA can also apply to family care, which means caring for a family member who contracted COVID, or caring for your child, a dependent child, at home because they were unable to attend on-site school due to COVID-related reasons. The FFCRA covers from March 15th, 2020 through September 30th, 2021. And it is very important to note that you may apply retroactively. If you haven't already claimed this benefit, here's how you may do so. The FFCRA program is really divided into two categories. The first is the COVID illness or quarantine. This covers up to $511 per employee per day for COVID or quarantine. What does that mean? If your employee earns $511 in a day or less, you can claim their full amount of pay. If your employee earns more than $511 in a given workday, then the maximum that they can claim is $511, regardless of if they made, hypothetically, $600 or $1,000. Now, if an employee was home, say you have an employee or yourself who was unable to work because they were caring for a relative with COVID, someone with whom they have a close personal relationship who depends on them for care, usually someone in your household, right? If your employee earns $300 per day, 2/3 of $300 is $200, and $200 is the maximum that you can claim. So if your employee that you're speaking about for this benefit earns more than $300 a day, the maximum you can claim is $200 a day. Now, say you have an employee who earns $150 a day, or at least on this day that we're talking about, right? 2/3 of $150 is $100. So that is what you can claim for this benefit. You can claim 2/3 of the pay with a maximum of $200 a day. Now, there are 2 periods for which you can claim FFCRA for COVID illness or quarantine. 80 hours are eligible between March 15th, 2020 and March 31, 2021. Another 80 hours become available between April 1st, 2021 and September 30th, 2021. That's 2 sets of 80-hour time blocks. And what's 80 hours? If you work an 8-hour day, if your employees work an 8-hour day, that's 10 work days. But it's by hour, it's not by work day, right? The other piece of the FFCRA is caring for children who are out of school. So if a child normally attended school on site at a place and it was closed due to COVID-related reasons, it must be closed due to COVID-related reasons, and the child is at home, this is your dependent child. It doesn't matter if they're home and school isn't open because of COVID. It doesn't matter if they're home and they're remotely learning at home. They're in session in school, but they're at home. That still counts if the employee is unable to provide work, right? So that's also 2/3 pay up to $200 a day. That means if the employee makes $300 or more, the max you can claim is $200 a day, $300 or more per day. I need to be clear. If the employee hypothetically makes $150, you're going to take 2/3 of that, which is 100, and apply $100 there. And when you're caring for children out of school, that can be up to 10 weeks of time, and it can be intermittent, right? So what that means is that if you intermittently, or one of your employees intermittently, had to be home to be with their child who could not attend school in person, it doesn't have to be consecutive. It doesn't have to be in the same week. It can be different days over the course of many weeks, right? You can claim each of those days. So how do we claim the FFCRA? We're going to document the rate and time by keeping a payroll report. This can be a simple spreadsheet or table, even handwritten, noting the days that were taken off, how many hours were needed off, and your rate of pay. The rate must be your actual payroll rate. If you're a sole proprietor, you can look to your annual taxes. Go to Schedule C, line 7. Schedule C, line 7, divided by 260 will be your rate. 260 is the number of working days in a year. So when you're dividing line 7 by 260, you're coming up with your daily rate. So next, you would alert the IRS. If you have W-2 employees, you need to amend quarterly payroll reports. So the FFCRA timeframe has ended. You are still able to claim the benefit from the time period during which it was active, but at the time that you're watching this webinar, you can no longer claim the FFCRA for the current time, for this current day or current week, right? So because the FFCRA benefit ended in 2021, you need to amend prior quarterly payroll reports. So that's Form 941X, and you can tell your payroll company to amend that for you. If you're a sole proprietor, you're going to be looking at Form 7202 for tax year 2021. Form 7202 is credits for sick leave and family leave. If you're looking to amend your 2020 tax returns, that's 1040X. If you are a 1099 employee, you're going to be looking at 1040 Schedule C. And for tax year 2020, you would be amending your tax return, and again, that's 1040X. And after that, all that's left to do is receive the money. The IRS will mail you your check. Now, moving on to the Employee Retention Tax Credit. The ERTC is payroll-based. It's very similar to the PPP, the Paycheck Protection Program, but much easier. The refund has no constraints and no forgiveness is needed. The ERTC covers from March 13th, 2020 through September 30th, 2021. There are 3 ways for you to qualify for the ERTC. The first is experiencing a mandated closure. If you experienced a COVID shutdown and you kept paying bills and paying your employees or providing benefits to them, you're eligible for that period. You can also be eligible for the ERTC because of a reduction in revenue. The ERTC is asking you to look quarter to quarter at your revenue, right? With 2019 being your base year. Comparing quarterly revenue starting in 2020 with 2019, if you experienced a 50% reduction in revenue, looking from the same quarter, say for instance, quarter 2, 2020, compared to quarter 2, 2019, then your eligibility would begin. The entire quarter is eligible if the quarterly revenue has reduced by 50% or more. And once you qualify for the ERTC by experiencing a 50% reduction or greater comparing quarters, this continues until you have less than a 20% reduction. So what does that mean? So say you experienced greater than a 50% loss in revenue in Q2 2020 compared to Q2 2019, okay? Say your revenue improved Q3 2020, and you're looking Q3 2020 compared to Q3 2019, but you still experience a 30% drop in revenue. Even though the revenue drop is less than 50%, because you triggered the ERTC from experiencing the 50% decline in revenue at one time, you are able to continue to claim it until you have less than a 20% reduction. So let's continue with our example. Say in Q4 of 2020, you have a 15% reduction compared to Q4 of 2019. The ERTC works in such a way that you qualify for one additional quarter beyond the minimum threshold for the drop-off, okay? So because you qualified for the ERTC following its rules and regulations in Q3 2020, you're going to continue to qualify for Q4 2020, regardless of your reduction in revenue or lack thereof, okay? Now, say you did great in 2020 for one reason or another, okay? Or at least your finances look like you're doing great. In 2021, if you experience a 20% drop in revenue reduction, Q1 2021 compared to Q1 2019, then you begin to qualify for the ERTC. So it is easier to qualify as far as the revenue reduction in 2021 than for quarters in 2021 than quarters in 2020, simply because in 2021, if you experience a 20% drop in revenue reduction compared to the same quarter in 2019, you are eligible, whereas you would need an initial 50% drop in revenue for one quarter in 2020 compared to 2019 in order to begin to qualify. And finally, the last way in which you can qualify for the ERTC is a partial closure of your business. And this has to do, or partial cessation of business, I should say, and this has to do with the reduction in capacity to provide goods or services. So hypothetically, if you had a capacity of 50 kids and you, because of distance regulations and other COVID protocols, you needed to only serve 30 children instead of 50. That is a significant reduction in your capacity to provide services based off of what you are able and licensed to provide, and you would qualify for that partial cessation of business. So an example that comes up in our work frequently is churches, right? So if a church has a child care division and that child care division had to reduce their capacity to provide goods or services in 2020, right? But the child care division might say, you know, our community was really generous during the pandemic. Our church is financially doing very well. We received a lot of donations. If you're able to parse out the child care center's finances from the churches and illustrate that the child care center experienced a 10% reduction in capacity, you're able to apply for the ERTC. It is important to think about two exceptions to this funding opportunity, PPP and the FFCRA. If you have either of these, the federal government is not going to give you this ERTC, the tax credit, for the time compensated from the PPP or FFCRA. But you can be strategic about it. If your PPP began mid-year and you qualified for the ERTC before you implemented the PPP, then you can claim the ERTC for the time period before the PPP. Likewise, if your PPP period ends and you find that later quarters do qualify for the ERTC, you can claim the credit for the ERTC after your PPP period ends. You can also choose to be intermittently on the PPP or the ERTC and switch on and off. There are two different time periods for the ERTC: March 13th, December 31st, 2020, and January 1st to September 30th, 2021. For the first time period, you can claim 50% of up to $10,000 in wages per employee for the year. That means there's an annual maximum of $5,000. For the second time period, spanning for the first 3 quarters of 2021, you can claim 70% of up to $10,000 in wages per employee per quarter. Remember, 2021 is per quarter, whereas 2020 is per year. So while in 2020, the per employee annual maximum was $5,000, in 2021, you're allowed to claim up to $7,000 per quarter per employee, which means that the 2021 per employee annual maximum is $21,000. And in order to reach that annual maximum of $21,000, you would need to claim $7,000 per quarter if you were eligible for each of the 3 quarters. So how do we claim the ERTC? First, you self-certify your eligibility. You simply make a record that you're eligible. We recommend that you send an email to yourself saying that you're claiming the ERTC because of one of these pathways. If you have a revenue report and can show that you had more than a 50% reduction for this quarter, or your license capacity before the pandemic was one number and now it's this other number that was more than 10% less, you record that in email. That is a self-certification. Retain the electronic copy, keep a print copy, but that's it. Next, alert the IRS through your payroll company and let them know that you need to amend your Form 941, which is your quarterly payroll report. And next, you receive your check from the IRS. At this time, it's taking 8 to 12 weeks for processing. This video was filled with so much technical information, and if you're confused, that's all right, and that's expected. There's help available. If you go to vecf.org/ARPA, you can find guides and videos, as well as links to resources in English and Spanish. You can also register for small group business coaching in English or in Spanish. So bookmark this page, set aside some time in your schedule to have a call with a coach and pull together your paperwork and prepare to receive the relief funds that you're eligible for. Good luck applying and take good care.